Welcome back to the deep dive. You often hear people talk about getting approved for a mortgage, but, well, that's really only half the battle.
It really is.
Our mission today is to dive deep into this idea of suitability. We're going to move past just simple affordability and look at how a professional has to guarantee that the product they recommend is a perfect, responsible fit for your life.
And that responsibility, it falls squarely on anyone giving personal advice. For a firm, making sure something is suitable, it all starts with the fact find, that, deep process of gathering all the information.
It's not just a box-ticking exercise then.
Not at all. It's the blueprint for any sound financial advice.
And that blueprint, that gives us our structure for this deep dive. We've pulled together the core materials, and we're going to break it all down into 4 main areas. First, the key checks an advisor has to perform.
Basic eligibility, yeah.
Second, we'll get into one of the biggest choices, the mortgage term and how you'll repay it. Third, we'll explore something a bit more psychological, your actual attitude toward risk.
And finally, we'll break down the really important rules around interest-only mortgages. We're aiming to give you the knowledge so you can understand not just if you can get a loan, but, if you should.
Okay, let's unpack that first stage. When an advisor is putting together that initial assessment, what are the hard numbers, the metrics that go into that fact find?
Well, they look at several core things. You start with the eligibility criteria.
Right.
This means checking 2 key things: the loan-to-value, or LTV.
Which is just the percentage of the property value you're borrowing.
Exactly. And the second thing is your net disposable income.
Okay, hold on. Let's pause there. Yeah. We hear about gross income all the time, but why is net disposable income the really critical figure here?
Because it tells the lender what your true capacity for payments is each month. I mean, gross income is pretty useless because it includes all this money you never actually see.
The tax and everything else.
Right. Net disposable income is what's left after tax, national insurance, any existing loans you have. It shows the genuine cushion you have, and that's the money that has to cover your mortgage payment.
So once they've confirmed you can actually handle the payments, they move into your preference for how you'll pay it back.
Precisely. That's the term and repayment preference. The advisor figures out if you need a pure repayment mortgage or interest only, or maybe a mix of the two. And they'll also note down your preferred term, even if, as we'll get to, the goal is always the shortest one you can afford.
What's really interesting here is this trade-off that advisors are always mediating: stability versus flexibility.
Oh, absolutely. The advisor has to gauge your preference. Do you need the certainty of a fixed rate, or are you okay with a variable rate that might be cheaper now but could shoot up later?
And if you go for that stability, that certainty, there's often a catch, right?
There is. You often get terms that penalize you if you want to repay early. That's a key trade-off you have to understand. Certainty now can mean less flexibility down the road.
And finally, they have to make sure you're ready for the actual transaction.
Yep, that's costs and credit. Do you have the cash saved up to cover all the fees, or are you rolling them into the mortgage? And then there's your credit history. It gives them a profile for how likely you are to, run into trouble.
And if your history suggests you're a higher risk,
then the conversation might shift towards what's called non-standard or subprime lending.
Okay, so that brings us to a huge regulatory rule. What if an advisor goes through all these checks and realizes, hang on, this client doesn't actually fit any of the products we offer? What happens then?
This is so important. The crucial rule is, if there is no contract that is suitable for you within that firm's range, the advisor must not make a recommendation.
So they can't just say, well, this is the closest fit.
Absolutely not. That would violate the whole principle of suitability. They have to, just walk away.
Wow. That must create immense pressure, though. As a client, you'd be frustrated, and the advisor's losing business.
It creates a massive ethical tension, for sure, but the regulator is crystal clear. The client's financial safety has to come first. The only real exception is when you're talking about a subprime specialist.
Okay.
In that very specific case, they have to prove that the terms they're offering don't actually put you at a disadvantage compared to a standard mortgage if you were eligible for one. But for most people, if it doesn't fit, the recommendation stops cold.
So once we know a client is eligible for a loan, the biggest decision is often the term. How long do you want to be paying this thing back?
That's right. And the core principle here is that you want to be out of debt as fast as possible. So the recommended term should be the shortest feasible term that works for you.
But in the real world, this is where it gets messy because financial safety and, well, consumer comfort don't always align.
Exactly. A shorter term means your monthly payments are significantly higher. That puts more immediate strain on your budget.
Whereas a longer term,
A slightly longer term creates that bigger cushion between your income and your outgoings. And believe me, that cushion is incredibly valuable to people.
we've got a great example here that really shows the difference.
Yeah, take say a £100,000 repayment mortgage at a rate of 4.8%. If you pick a 20-year term, your payment is $602 a month.
Okay,
But if you stretch that out to 25 years, the payment drops to $522 a month.
that's an 80-pound difference.
And that £80 a month might not sound like a huge amount, but for day-to-day budgeting, it's critical. It often decides whether a family can actually afford the house they want in the first place.
So the advisor is caught between this financial principle of paying debt fast and the very human psychological need for that breathing room in the budget.
That's the tightrope they walk. And with affordability being such an issue, you see more and more people push toward those 30 or even 35-year terms just to make the numbers work.
But the advisor has another huge responsibility here, which is retirement risk.
Oh, absolutely. They have to stress the importance of your age and when you expect to retire. If that mortgage term runs right up to or even into your retirement,
You've got a problem.
you might. They have to make sure your post-retirement income, pensions and so on, will be enough to keep up those payments. The idea that your income will just stay stable for 30 years is often the riskiest assumption of all.
Right. So let's talk more about risk. The types of risk in a mortgage are, well, they're complex, and they have to be explained clearly. It's not just one risk, is it?
Not at all. It's a whole basket of them. We can probably group them by where they come from: risk to your home, risk from the market, and risk from the product itself.
Okay, let's start with the most serious one.
That's the risk to the home. It's the most basic danger. You fail to keep up your payments, and you face potential repossession.
And then a market risk.
Negative equity. This is what happens if you borrow a really high percentage of the property value, a high LTV, and then house prices fall. Suddenly you owe more than the house is actually worth.
That was the big story back in 2008, 2009. Is it still a major concern?
Less so now, because the lending rules on LTVs are much tighter. But the primary market threat today is different. It's interest rate risk. The risk that rates suddenly jump and you can't afford your new higher payments. This is the main thing the FCA stress test is designed to protect you from.
And what about the risks that are tied to how you choose to pay the loan back?
That brings us to the last two. For interest-only mortgages, there's repayment risk. It's simple, really. The risk that you get to the end of the term and you haven't saved up the money to pay back the actual capital loan.
And the final one is a bit tricky because it's a risk you take on when you're trying to avoid another risk.
You're talking about fixed rate risk.
Yeah.
When you lock in a rate, you're actually facing two potential problems. First, variable rates could fall below your fixed rate, and you end up paying more than you had to.
Right.
But second, and this can be more devastating, is the risk that when your fixed deal ends, the new rates are way, way higher, and you face a massive payment shock.
And just to tie back to those interest-only products for a second, if you're using an investment to pay it off, there's another layer of danger.
Yes, that's what we call underperformance risk. If you're relying on, say, an investment portfolio to grow and pay off the capital, there's always the risk it just doesn't perform as well as you hoped.
And you end up with a shortfall.
Exactly. You have to be fully aware of that possibility from day one.
So all those risks have to be matched to the person taking on the debt. And that's where attitude to risk comes in.
Right. The two main drivers here are the risk of not being able to repay and the risk from interest rates changing. Advisors tend to put customers into one of three profiles.
Cautious, balanced, and adventurous. How do those profiles actually map onto the products?
Well, a cautious customer has, minimal risk tolerance. Their absolute priority is knowing the debt will be repaid. For them, a full repayment mortgage is almost always the only suitable choice.
And
A balanced customer is willing to take on a limited, calculated risk if the rewards look good. They might consider a mortgage that's, say, part repayment and part interest only.
And then you have the adventurous customer at the other end.
Yeah, they're prepared to take on a significant level of risk for a chance at bigger rewards. They might go for a full interest-only mortgage linked to a high-growth, high-risk investment, fully accepting it might not work out.
But the advisor has to be sure that's a genuine preference,
Right.
not just a way to borrow more money.
Oh, absolutely. And that's a key point. Historically, this whole assessment was, well, it was very subjective.
Just a conversation.
Pretty much. And that's why regulators push for a change. It often lacked any real rigor. Now, to properly align the product with the borrower's psychology, advisors are using formal questionnaires and even psychometric profiling tools.
Wow, psychometric profiling. That sounds like you're bringing behavioral science into it.
Yeah.
What are those tools looking for?
They go way beyond just asking you to rate your risk tolerance on a scale. The software looks at your financial knowledge, your past experience, your personality, and crucially, it uses what-if scenarios.
Like what?
Like, how would you react if your investment suddenly dropped by 30%? Or what would you do if interest rates jumped by 3 points overnight? It's about seeing how you'd react under real financial stress, not just how you feel on a good day.
That's a much more robust way of doing it. And even for the most adventurous person, the regulator has one final safety net.
They do. No matter what you say your risk tolerance is, the Financial Conduct Authority, the FCA, enforces the interest rate stress test. The lender has to prove you could handle payments if rates rose significantly. It puts a cap on the risk anyone can take.
Okay, let's use our final section to do a deep dive on the interest-only model itself, because that's the one that caused so much trouble in the past. Why did it create such big problems back in the late 80s and 90s?
The intention was good, it was about flexibility, but what actually happened was lots of borrowers just used it to cut their monthly bills so they could get a bigger loan than they could really afford on a repayment basis.
And then the clock ran out.
The clock ran out, and they hadn't arranged any way to pay back the actual capital. It led to these massive shortfalls, a whole generation of people facing potential eviction. It was a disaster.
So what's the regulatory fix now? What does a lender have to see before they'll approve an interest-only loan today?
Under the FCA's rules, the MCOB rules lenders have to make sure you have a clearly understood and credible repayment strategy. Credible is the key word the regulator hammers home.
Okay, that word credible is doing a lot of work there. Can you give us some examples of what counts as credible versus what's just too risky?
Sure, potentially acceptable strategies would be things like regular scheduled savings into an investment, or maybe periodic capital repayments from a definite irregular income, like a contractually guaranteed annual bonus.
What about selling something?
Selling other assets you own, like another property or a piece of land, that's also seen as credible, as long as its value clearly covers the debt.
And the unacceptable ones, the things they'd say no to.
Well, the classic unacceptable strategy is saying you'll use an expected inheritance. It's just too uncertain, you don't have a right to it.
Right.
Also, saying you'll just take out another loan later to pay off the first one, that's a no-go. You're just kicking the can down the road. And most importantly, you generally can't rely on selling your main residence, the home you live in.
So once the loan is out there, is the lender's job done? Or do they have to keep checking up on this strategy?
No, they have to monitor it. It's mandatory. Lenders have to review your repayment strategy at least once during the mortgage term to make sure it's still on track.
And they have to keep records of all this.
Rigorous records.
Yeah.
For the entire term of the mortgage, they need to have the evidence for why they made the decision they did.
And finally, we should just mention a specific type of interest-only loan for older borrowers, the RIO mortgage.
Yes, the retirement interest-only mortgage. It's for people nearing or already in retirement. The capital is repaid much later when the borrower passes away, moves into long-term care, or sells the house. The key difference is the affordability check.
How so?
It's still required, but it's based only on your ability to afford the monthly mortgage interest charges, not on proving you can also pay back the giant lump sum of capital.
So what does this all mean for you, the borrower? We've seen that suitability is, well, it's a really complex decision.
It is.
It's about balancing those hard regulatory checks, the stress tests, the credibility requirements, with a psychological assessment of where you sit on that risk spectrum. Cautious, balanced, or adventurous.
But the fundamental goal is always to minimize your debt by aiming for the shortest term you can feasibly manage.
Which brings us to a final thought.
Right. If we connect this to the bigger picture, advisors are always in this battle between that professional principle, minimize the debt, and consumer behavior, which is driven by affordability. We know people are insisting on longer terms just to create that financial cushion. Yeah.
So it raises this really important question. If an advisor has a balanced customer, someone who could technically afford a 20-year term, but they insist on a 30-year term purely for that extra stability each month, when does that informed personal preference from the borrower actually outweigh the professional principle of minimizing the term?
That's the tension right at the heart of modern mortgage advice. It's definitely something for you to mull over.
Absolutely.
And that's our deep dive into mortgage suitability. We hope you feel better informed about all the critical checks and balances that go into it. We'll see you next time.